Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. Welcome back. Today you're in for a treat, as well as the next handful of episodes. And I want to give you a little bit of context on why I'm doing this podcast, as well as the next 3 to 5 that are coming out. I have been spending, it feels like almost every single waking minute for the last 6 months, really trying to wrap my head around all of the valuation jargon that the M&A marketplace uses, how that ties into the owner-operator's goals of free cash flow, and then the ownership framework that I've been working on, and really diving and focusing in on weighted average cost of capital, which essentially is just the risk of your future cash flow, has been something that I literally want to internalize and understand better than anything out there, because it's been what I call like the last puzzle piece of the knowledge that I've been working on for a decade. And I started to run into some conflicts as far as like how I was thinking about it, because my head was getting wrapped around in a pretzel on how the weighted average cost of capital relates to the owner operator, which at the end of the day, when we own a company, all we really care about from the investment perspective is what is my future cash flow going to be after working capital, taxes, reinvestment, and debt. That is whatever's left over is yours. And there's always this trade-off of, do I put more money back into the company or do I take more money out as the owner for distributions? But we have to understand all this jargon in order to figure out what metrics to work on. So I got Ken Sanginario on the show and John Lawlor, who have been working on the value opportunity profile. And Ken's honestly one of the smartest owner, operator, and finance people I've ever met. And what we start this episode in is really unpacking normalized EBITDA compared to free cash flow. We talk about internal rates of return. I started talking about return on equity and really understanding all these financial jargon and these metrics as relates to valuations to better understand what metrics should we be focused on as we run the company so we can make sure that we're placing our bets of reinvestment versus distributions correctly. And so we spend a lot of time thinking through that, as you're going to hear as I'm learning. Then we talk about Ken's value opportunity profile system and then how he created that and how that helps us like identify the cash flow from a theory of constraints so we can better understand how do we constantly be working on the bottlenecks to create additional future cash flow. So I almost didn't release this episode because I have Ken coming on again in about 4 or 5 episodes with even more clarity on this. But I had one of my friends who listened to this. He's like, you got to release it, Ryan, because we're better understanding your learning journey. So I hope you're going to enjoy hearing me as I'm trying to learn and then bring that back home to the owner operator, as well as then potentially eventual sale. But what I continue to hear and come back to the conclusion of the M&A marketplace and all the jargon that we use is different. And that game is very important, but we need to understand how that game is played when we go to sell the business, and those metrics are different than what we're doing while we run the company. And then we're going to be talking a little bit about, again, Ken's system and how it brings all of that jargon and the goals of free cash flow to the practical level for the owner so we can actually make better decisions while we run the company, but that what are the implications when we go to sell it, and how do we essentially play both of those games appropriately so we can essentially look at the matrix and understand what the implications of our actions are. And then the next couple episodes build on top of this. So next week after this, I will be having Jeff Butner, who's a partner of Butcher Joseph, and they're a merger and acquisition investment banker, and they do sales to ESOPs, third-party strategic buyers, private equity firms. Could be a bolt-on, but it also could be a platform. And they do management buyouts, and they're essentially constantly trying to match the capital based on risk. And so I spend a lot of time talking to Jeff about how each of those buyers are structuring deals in order to get their rates of return, because every ownership structure and their timeline and their desired internal rate of return and need for free cash flow versus the eventual sale will dictate how the structure of a company's sale and purchase works. And then I'm going to continue building on top of this with Dave Deal, who's the CEO of Prairie Capital Advisors, another investment banking M&A firm, where he and I are going to really unpack deal structures, because the purchase price is just the tip of the iceberg. And whether it's cash at closing, seller financing, earnouts, rolled equity, escrow, working capital adjustments, all of those things will impact how much money you get at the closing if you were to sell. And why this is so damn important is because by understanding what the free cash flow and the valuation metrics are while we own the company is important. Then also understanding when we go to do a deal, what are the terms and the concepts used, and then how do the different buyers use those different terms and concepts in order to accomplish their goals? Because at the end of the day, you want to match your goals with the buyer's goals. And then after I have Dave on the show, I have Ken Sanginario again back on, and I just got done interviewing him today, which is when I'm doing this intro to completely re-go through all this to say, okay, the big picture, how and why does free cash flow and the internal rate of return to equity and the shareholders matter most? And how do all of these terms fit together? Because I constantly want to better understand how do we play the game of capitalism so that way we can better understand how to use our time. Because time is all we have, and money, which is free cash flow and equity, is a result for how we spend our time creating value. And so I just can't tell you how much fun I had on the podcast with Ken just now, but I apologize for the little bit longer of an introduction, but I wanted to give you some insights on why I released this podcast and what's to come so you can join me in this journey of better understanding all of this stuff so that way you can focus your time and your decisions onto what matters most. Thanks everybody for tuning in. I really hope you enjoy this. If you do, send it to a friend. Go rate the show on any podcast player that you're listening to. And don't forget that Spotify also has the video tuned into it as well. Thanks, everybody. And I hope you enjoy this conversation with Ken and John. John and Ken, thank you so much for coming on the show.
Yeah, pleasure to be here, Ryan, as always.
Same, Ryan. Happy to see you and look forward to having the conversation.
And I'll make sure that we can, I'll guide us as we're having this three-way conversation. So if we go over each other, it's all good. I'm very excited for this. My listeners are familiar with you, Ken, and some of the fun, in-depth conversations we've had about the 8 functional areas, de-risking cash flow, sustainable, predictable, transferable. I mean, we got the beat and the drum here, and I'll put the links to our previous episodes in there. And we want to dive into some conversations about free cash flow versus normalized EBITDA and return on equity, and how the 8 functional areas is the solution to articulate and to prioritize the right things. But before we jump into that, and I give a little bit more context to what I want to dive into, John, why don't you give a little bit of your background too, because I'm excited to have you here to join Ken and I.
Sure. So as you know, Ryan, I'm a partner in crime here with Ken. Been working with him for well over a decade. But my background, I've worked in all sorts of companies, right, size-wise and all that, and had the fortunate experience to be able to work in a startup and a merger and an acquisition, and been through all that. But I've always loved learning about how companies actually run and what makes the good ones good. And when I decided to go out on my own, which is almost 2 decades ago, it was really about I wanted the opportunity to work with companies to actually help them improve their businesses. I wanted to do the implementation part of it, right? Really get involved with them. And that fits my personality. It fits what motivates me. And, it just, Ken and I were introduced to each other and realized that we were doing some similar things using different tools. And there was a huge opportunity to collaborate. So that's what we've been doing for well over a decade now, and really working with business owners to change the way they think and do business.
I love it. And we're going to take the listeners on for a ride today because so like I said before we hit record, I'll for the listeners, bear with me too, because what I want to do, and here's what I want to do, you guys, is tee up where I'm at with my journey of understanding weighted average cost of capital, return on equity, because I'm tasked with articulating this to my clients and helping then regurgitate and build the best in practices to my clients. Because Ken, as you have realized, after you attended my group call with my clients, a lot of people are pumped, and they saw how the VOP and the 8 functional areas fit into their ownership journey. And EOS, you got this big, huge gaping hole of like, what the hell are you working on? And how do you know what you're working on is going to grow value? And you guys, that's where I think we're going to end up on, and you guys can continue to enhance that. But what I'd like, if you guys can just give me some grace, I want to explain to you where I'm at, because I want you, Ken and John, and depending on your level of technical part, but on the financials, of like to either correct me or tell me I'm right. It's because so I've been working with GPT and a bunch of other stuff over the last 90 days going, okay, like that last conversation can help me better understand weighted average cost of capital and the multiple better than I've had before. And I had focused on like the buildup and explaining people like the buildup is how to think about an investment and like and what your return should be based on the investment. You insert into the conversation more on the debt factor and like and it just really started like all clicking together. And I've been teaching for 7 years that the one divided by the WACC is the multiple. And the company specific risk is the thing that they can control. So like I've been beating that drum for a long time, but like really understanding return on equity was something that I wanted to I wanted to be able to articulate it, not just like because I not just understand it in my head, but articulate it. And so as I was unpacking it more, and this came to light, you guys, because I've been working on a couple of deals with my clients around a million-ish normalized EBITDA, call it a million one. And everybody's like, hey, that's worth a 4 or 5 multiple. And they just throw this shit out there, which you and I all know. And like the free cash flow could not service the debt on the 5 multiple. And like I've been through this process in the past, but so many times it's to a third party where they're going to figure out how to get their return. And Ken, you and I have talked about in the past where like so many acquisitions don't get a return above their weighted average cost of capital or their cost of capital. So it doesn't actually yield more cash flow. And so as I went down this, I'm like, what the hell? I mean, I know normalized EBITDA is a big deal. I've been teaching it for 8 years. And that right there is a huge transition period for people mentally away from revenue or net income. So like I've been taking them this far, but then as I've been like diving into the free cash flow is actually what you measure for the return on equity. I'm going like the M&A market is so effed. I can't believe it because of how much crap goes on that's not tied to free cash flow. And there's just this hot potato of M&A. So I'll stop right there because I could keep going, but am I on the right track, Ken?
Yes, you're on the right track. However, I'm going to throw a wrench into part of what you just said right
Keep
off
doing
the
it.
bat.
I want it.
When you talk about return on equity,
Yep.
so there are lots of different return ons. There's a return
Yeah.
on equity, there's return on assets, there's return on invested capital, there's return, right?
Yep.
And any measure that starts with return on is an accounting measure.
Okay.
And accounting measures are wildly inconsistent in the way that they're calculated and in the way they're calculated both by a company in the form of EBITDA. Like you could take even normalized EBITDA. If you gave the exact same fact pattern to 10 CFOs and said, tell me what the normalized EBITDA is here, you're going to get 10 different answers.
Agreed. Yep. Okay.
And so EBITDA in and of itself is, I'll say, it's manipulable, and I don't mean that in an underhanded kind of way. It's just
a fact because like you and I, like you and I and John could all look at a different company or different companies, and isn't it, Ken, just this pursuit of trying to have a discussion around like a business as a standard, but like we still have to like there's a lot of failures in that freehand or shorthand, I should say.
Yeah, and it's a matter of different companies have different policies, different accounting methods. So EBITDA is not a good measure. Even normalized EBITDA for a given company, it's good to look at that when you're trying to compare a company against itself year over year. You normalize the EBITDA so you can tell, is this company improving year over year? That's fine. But then when you're calculating return on, it's that further
complicates things. So let me continue where I am at mentally with this and how, because this is really important for me and my clients as we're talking about. And John, I'll give you a little bit context too, along with the listeners of like, if we understand this game, then we can actually just figure out what we're trying to solve for. Like, so like back to like the normalized EBITDA, like, can I agree with you? You can do year over year and you're tracking that. And I always suggest everybody when they close their books, do the normalization. So you're building the story and the footnotes of your company. You can look at the TTM. So that's all fine. But effectively, that normalized EBITDA and that story that they're building is for a potential transaction or to just do some basic comparisons. Because like, I mean, when you do an ESOP, I mean, you can freaking like, you can craft the story. And, you know, especially with the VOP and the financials and stuff that we're working on, you can craft that story, especially if you have an understanding of company specific risk to get that deal done along with any other PE firm or third party. But for the clients that you met, Ken, like they care about actual cash and like actual return on the growth of their asset. And here's why, and here's how and I want you to know, again, I want you to explain to me if I'm on track or off track, but like if you and I, or let's say I put $1 million into John's business, $1 million in cash. The reason I would do that is because if I did the buildup methodology, I'd look at the trade-offs of treasuries. And this is maybe round 5 with you and I, Ken, which is the debasement of the dollar and how like we have to actually get a return above and beyond the money supply growth. But let's get that out of here for a second and say, okay, there's the treasuries. So that's, you know, call it 4.5%, 5%. Then there's the equity risk premium, the size premium for smaller companies. Then there's the industry, and then there's company specific risk. But like I would go through my own investor profile decision, say, I want to give John $1 million because I want 20% return. And I have determined that John can help me get there. And then by the end of next year, I need an additional 200 grand in cash, right? To justify that return. And then I see you have a question, but here's what I'm thinking about this is that equity gets used, you know, so John will take that equity and then invest it in the infrastructure, like the 8 functional areas. And then, so the equity would go to use. And then at the end of next year, on the cash flow statement, you'd have the cash flow provided by operating activities, which might have like 500 grand. Then you take investment activities. Let's say he puts 100 grand into equipment, and then there's taxes, then maybe 100 grand in distributions, which would leave 200 grand in free cash flow, which am I thinking about this the right way or like,
Well, the return
the total no is fine too.
I mean, you're kind of mixing concepts. So if you invest $1 million and you're expecting $200,000 additional cash at the end of 1 year, that's called like a cash on cash return. Most investments are not generating cash on cash returns that way. Some do, but most don't. So usually if you're looking for a return, you're looking for a return over the time horizon of the investment that you're making. So you may
that's where the net present that's you're talking about the net present value of the discounted cash flows, the IRR of the distributions and the finite.
Yeah. Like private equity firms are investing, they're investing in a time horizon, typically like 5 years or so, right?
Mm-hmm.
So they're looking for their return by the end of year 5 or into year 6,
Yep.
but they're not looking for that return at the end of each year.
Fair enough. Yeah, and fair enough. And here's yep, and I appreciate that. And
IRR is very different. Where I was going earlier,
Yep.
sorry to interrupt you, but
no, go for it.
I was saying return on, any of those return ons are manipulable, say.
Okay.
IRR that's what to use. That's a finance function, not an accounting function.
Right. Which is the discounted cash flow, right?
In IRR, there's nothing that can hide. It doesn't matter what kind of policies, what kind of accounting methods they have. It doesn't matter how they account for anything. Nothing can hide in an IRR calculation.
But for the listeners, right? You would take the dividends along that time period, and then the terminal value of so like if John wanted X amount of valuation, you would take all of the stream of cash flows and then that new value discounted to today, which is where then the build-up discount rate comes into play. Or am I correct on that?
Yeah, that's right.
Okay, because So
you're gonna net present value
yep. Yep.
any distributions along the way,
Yep.
and then you're going to take a terminal value at the end,
Yep.
and you'll take a net present value of that.
Okay. So
Net
here's
present value and IRR are the same calculation, parts of the same calculation.
okay. Super helpful. And I'm very familiar with those concepts, and that so here's why I think I've got myself wrapped around an axle with this stuff, and how and why I want to clarify this stuff before we getting into the VOP, because here's it relates to the decisions that these owner operators have to make, right? And all the confusion wrapped around like doing a third party sale or keeping the so here's like the biggest decision that I'd say half of my clients are making right now is, do I sell my business or do I hire a CEO for $250,000? And like, here's why I'm challenging my clients so much, Ken and John, is because what else are you going to do with the business? They have a freaking great company. From an asset perspective, I'm not discounting the fact that their identity is wrapped into it. They're exhausted, regardless of their age. They don't want to be in the operations. And we're giving all this context to the VOP, how to think about this. But I had this client where like kicking out 40 to 45 grand a month in free cash flow, like after reinvestment, working capital, taxes, and their distributions are 40 to 45 grand a month repeatedly.
Wow.
Well, right. And like, and I've, what's that?
CEO? Did you say he needs a CEO?
Yeah, right.
Can I volunteer? Well, and honestly, anybody listening in, we're open. But here, and like, so they were a cold client of ours, Ken. So Pat Hobby built out the 3-statement model. So like, this ain't no joke. Like this shit is for real, very like repeatable. But like, what the challenge is, it's like, okay, after taxes, working capital, and like we have the distributions there, and that's not the salary either. Like, it's like, okay, well, you sell the business, you get $3.5 million of dollars up front. What the hell are you going to do with that money? And you go back to the build-up methodology, and you know where you end up? Buying a commercial cleaning business that kicks out $450,000 in free cash flow. And so like there's this huge, like what I'm trying to do here is say, okay, like from an investor perspective, when you look at your whole portfolio, like a family office would, what is the actual return that you're getting in your current business is one part, Ken. But then the second part is then the cash flow, the actual money has to be able to satisfy their life needs. And we have to be able to hire the $250,000 CEO and still maintain whatever cash flow, free cash flow that they need. So this decision tree is like perpetually coming up. And I want to help people go, okay, if you keep your business, here's the return you're getting and you should get, versus if you sell the business, like you got to go get a return somewhere. And then how does that impact your free cash flow for your lifestyle? So that's a lot of Ryan talking, and I apologize, John and Kim, but like I wanted to frame up the.
Do they consider at all doing a recap on the company and keeping ownership, like putting some debt on the company, taking a big distribution, right? Then they can take that distribution, which wouldn't be as much as if they sold the company outright, but it would be a lot more than just taking their monthly distribution as they go. They could take the distribution, reinvest it, and get some diversification in their portfolio, so they're not 100% like leaning on one company and one industry.
Well, they would
repay the debt over time.
I think that is absolutely something that people should be thinking about. And it's just like refinancing your house if you got too much equity in it, so you can stay below the 80-20. But here's what's interesting though, is that by hiring that CEO, you're already then burning 20 to 22 grand a month in cash.
Yeah.
And then you have to do the recap. Go ahead, Jeff.
Well, sometimes that's the case. But if you turn around and say, well, Mr. Business Owner, you're not going to take a salary anymore. We're going to pay it to the CEO and you're going to just take the dividends. It changes the equation a little bit, right? So it depends on how they want to do it. I mean, if you want
and I agree, but this is they're probably paying themselves 100 grand less than they should. So the normalization would eat up another 100K in cash. So they're probably paying themselves, I think it's 125. Then they would have to call it another 125. So another 10 grand a month. But then you're So then it's like, oh, it depends on the ability to generate cash flow outside of their company. Here's why I think this is so interesting, John and Ken. It goes back to that Census Bureau thing that you and I are constantly harping on. This is a really good company. It's $1 million in normalized EBITDA, but there's not $1 million in cash flow there. And everybody needs to know that. And then like, here you are in a situation where by hiring a $250,000 CEO, it's not like you don't have, private jet money. It's like you're able to, like, depending on the ability to make money out of your other portfolio, you might be like cash flow poor potentially. I mean, like, but it's important as people have as I'm helping them identify their cash flow needs, their overall portfolio, and how the actual intrinsic valuation of their business sits in their situation. Ken, and John, this is why I'm trying to help everybody understand the terminology, but then the actual implications of cash each year and net worth return. So it's been a lot of Ryan talking, but I'm so curious on your guys' input on this.
I'm going to give you just a quick example to sort of pile on the point that you're making about EBITDA versus cash flow, even normalized EBITDA versus cash flow. John and I had a client a couple of years ago, $100 million revenue, 60 million EBITDA. Year in, year out, 60 million EBITDA. The owner was looking for, I think he was looking for he wanted like a 12x multiple, 12x multiple.
I would too.
60 million. But he's looking at 60 million. But I went through the free cash flow calculations. His free cash flow was like 12 million. Because they had so much. This was a huge entertainment facility.
Because a lot of CapEx or
a lot of CapEx every year. A lot of CapEx, a lot of taxes, a lot of yeah, I mean,
So what okay. So it's so important to be talking about this stuff before we jump into the 8 functional areas and like what you had the problem that you have solved, Ken, because I became a disciple so long ago because it has to be practical. We have to be making these decisions. But like what I find so fascinating after 2,000 people in my workshops, normalized EBITDA is like mind blowing for half the people or more.
Yeah.
So like, I'm not about to go in there and talk, I mean, like working capital.
No, that's a good start. Normalized
right. It's a good start, but this is where then once people go through the workshop and get more bought in, my clients, this is where the decision making really comes into play. Saying, okay, you have your 3-statement model now. We understand free cash flow, your working capital needs, and like they have to come up with that goal to be able to say how much are you going to reinvest, what will your taxes be, and then can you maintain your lifestyle while doing that reinvestment. And so like it's just,
well, I think it's Ryan, you're talking about the majority of businesses out there, right? Who've never really thought about their business as a CFO. They've thought about their business as a business owner, but more from an accounting standpoint, right?
Yeah, mitigating annual taxes, John,
and, really
and like trying
to thinking about that wealth engine and how do I really maximize cash flow and value. And I think that's one of the transformative things that we try and work with people on. And it's why
Right. Don't you think, John? And it's outside of even just a CFO, because I think just thinking about the mindset of the people listening, and CFOs are necessary, but like the goal is to be a capital allocator and to get out of the job. So they have to be thinking about it like an investor. And I knew what you were trying to say. I'm completely agreement.
It's more the
complete agreement
and
with
the tools of that discipline being applied to a business instead of just basic accounting.
Right. And then by understanding it, then it goes into practical decision making of like normalized EBITDA, what's the market value versus free cash flow, and having to reinvest. Because so as we tee up and if we want to continue to triangulate in these concepts, we can. But like the place that I see the VOP and what you have solved, Ken, is, I mean, I've been joking around now for 2 months. Everybody's going into annual planning and they're just making shit up. They're going to make up their rocks. And it's like, well, how much cash flow do you need, owner, Mr. and Mrs. Business Owner? Like free cash flow, like actual income out of distributions. And then what's your goal? But like the only way, back to your point, John, and I don't know if you're familiar, but my old company, we used to do fractional CFO services. And You have to have a 3-statement model that's interconnected and have a specific target, because that's the only way you can see working capital and reinvestment needs and distribution and taxes and what your actual constraints are. Then you go in. So if you have, okay, like let's say it's $1 million in normalized EBITDA, let's say you got 300 grand in taxes, then you got 200 grand in distributions. Depending on your working cap or your CapEx, it's like you have 400 grand left. What are you going to do with it? And like, that's what you fit into the CapEx / reinvestment versus distribution decision tree that everybody needs to go through. You help solve that, but it's not just made up like, and I don't want to be too critical of the value builder system and all that stuff, but like, what's it tied to? It's tied to like, it has to be tied to the weighted average cost of capital financials, right? So anyways, help me pick back up where I'm at here.
Well, that's how they decide if using weighted average cost of capital is how they start to decide how to allocate that capital, if they can reinvest that free cash flow at a higher rate than their WACC.
Can you, let's double click on that. Can you just, because we covered a lot of different things already.
So weighted average cost of capital, right? That's their investment hurdle. Yep. So that's the rate above which they have to generate a return
to make it worth it, right?
On any investments in order to create value.
So Ken, sorry to interrupt, because this is important for me to understand, is the weighted average cost of capital and the hurdle rate, like you said, because like if in the example where I gave John $1 million, I would have my expectations, and then that would be his hurdle rate, right? His cost of capital would be the debt that he was accumulating or using plus my equity. But for the owners that started and grew it through sweat equity, is their target return the exact same thing as the weighted average cost of capital, where they have to clarify their goal, because the goal is almost their target return, but also their cost of capital?
They even if all of their equity is sweat equity, the weighted average cost of capital is still their hurdle rate, because that's risk adjusted for their business. And if they can't get a risk adjusted return higher than their risk adjusted hurdle rate, then they should be taking that capital and investing it somewhere else.
It's the opportunity cost of what else they could be doing.
Opportunity cost. Yes.
Okay. So, okay. And got it. So then like at any given point, we would say, okay, John's business right here has a weighted average cost of capital 28.5%.
Mm-hmm.
That's what he needs to hit to make keeping his money in his business worth it versus putting it somewhere else.
Yes.
For the risk that he's taking.
Yes.
Okay.
Now, there may be reasons why people don't care about that. I had a client years ago who was in the audio-visual rental business. Big business, rented all the AV equipment to hotels and conference centers and that kind of thing. National company. And it was owned by one owner, and she was getting like, I don't know, it was in the single digits return on her, right? And I said to her, like, why with that kind of return, honestly, you'd be better off just selling the company and putting the money somewhere, putting it in the public market. You're going to get you're going to probably get at least a 10% return on a diversified market investment. And she said, I don't care, because it's the families that I support. It's the employees and their families. That's what I'm in it for. I don't care about the return. I was like, well, you're pretty much
articulating
the value of the company every year. You get this low return. She said, I don't care. Okay, then that's an investment value.
Well, it's an educated decision too.
It's a value.
Right, I agree with you, John.
Educated, yeah. So, okay, well, that's fine. But if somebody's trying to maximize the return on their overall life's investments, then that hurdle rate is key.
And is there a dynamic where, like, so you always, like, I mean, I hear that a lot, where you could always put it in the S&P 500, which is the equity risk premium, right, and get that 10%. Doesn't mean you're going to get the 10%
every year.
distributions in the
No,
free cash flow, right? And so this is where like the free cash flow thing comes in. It's like, okay, because like, and especially when the salary is tied into there, but let's assume that the salary is decoupled over time, because that's the goal of my clients. Like, just give choices so you can do whatever you want, but like, because the income, it might be an income play that they're having right now, even though that the valuation might not be high, right? I mean, and how does that factor into risk or the decision making process? Do you feel?
well, I'm going to go back to the investment horizon. So, and the whole IRR concept. So, IRR, just to be clear, so we talked about net present value. I think your listeners maybe understand how to do net.
Why don't you do them some justice anyways, just in case?
Well, if you have cash flows in year over year, and you're discounting those cash flows back to the present value at your discount rate, your weighted average cost of capital,
the risk of that cash flow, right?
It's the risk adjusted cost of capital. You're discounting all of the cash flows. The discounted value of those collective cash flows today is the net present value. Okay, so that net present value would change based on whatever your weighted average cost of capital is. IRR is simply the discount rate at which the net present value of all those cash flows would equal zero, meaning you've just exactly made your cost of capital.
Got it.
No excess, no shortfall. If you exactly make the return equal to your weighted average cost of capital, that's the discount rate that IRR is that discount rate.
So the IRR. So like when someone says that private equity needs to make 23% IRR, they're saying that discount rate is exactly 23%.
Yes.
Okay. And then so they're taking that discount rate. So that would be the WACC then? You're saying that so the WACC would need to be 23%, which would they'll be taking that stream of income and all that money and discounting it by 23% to today.
Yeah.
So the discount rate is exactly what the IRR would need to be. And what I think is like
the net present value of all of those at 23%, the net present value would be zero. Because they exactly earned their 23%.
Got it. Yep. So, and then anything above that would be a higher return than your cost of capital.
Yes.
And what I think is insanely important out of all this, outside of all of this jargon, in case people are having a hard time, is that we have to come up with a freaking timeline. Like you have to do goal setting, right? Like that's what I think is so fascinating. We can't just,
come on.
It's like, where are we going? I don't know. I'm just hoping that I get some more money next year. And like in order to even do this planning and to even have any of this insight, we have to say, well, what is the goal for the value that you want and the stream of cash flows?
Yeah.
Which is why I'm always talking about time, cash flow, and equity, because it's like those are the trade-offs.
Yeah.
Those are the inherent constraints. The theory of constraints, essentially.
And different investments. I mean, if they're allocating the capital inside the company, they're going to allocate it to make additional investments. And they might expand a facility, they might expand a product line, they might expand the target market, whatever it is that they want to invest in. Those are different. Each one of those is a different investment decision. Each one of them might have a capital allocation to it. It's not just going to be one investment, but collectively, all of those investments have to exceed their weighted average cost of capital, their hurdle rate.
Which is their target IRR.
Yes.
Right?
Yeah.
Okay. Now go for it.
Now, I'm sorry, you said you wanted to get into the weeds.
No,
Well, you guys are in the weeds.
this
We're
is
definitely there.
this is for me.
Yeah.
This is for me because like, so John, a little bit about me is like, I can't not think about this shit. Otherwise I can't figure out what to work on. Like I have to understand how it works in order to then like, if I understand it, then I can forget it. It's kind of like how I think. And so like, I have been working, Ken, since our conversation, I've been with GPT, with my slides, with all this stuff going, okay, like, cause at the end of the day, there's like two parts of this. Is like the theory of all this, like not the theory, but it's like how this stuff works. But there's the how it all works is what I call the matrix. It's like we figured out how the matrix works, but at the end of the day, my client's decision tree is like pretty straightforward. It's like, how much cash do I have? What am I going to do with it? And will I have more either cash flow or more equity? Because the investment should grow the equity, or do you want more cash flow? And so it's this time, cash flow, wealth trade-off that they need to have some thought process behind and then like have a system to make those decisions. But I say that, Ken, because yes, we want to get into the weeds, but like, it's because it's like the why, like what is driving the private equity market, which is they raise money to give investors an IRR. And then they have to then go play. This is the game that they're playing. The way we communicate is normalized EBITDA times a multiple. The multiple is the inverse of the weighted average cost of capital, which is the risk. But then we inherently get to like what you've built, which is a strategy on how to solve all this. But I say that because like, yeah, there's a lot of weeds, but like the way of communicating to my clients, like you got it. Let's say you got like one of my clients, one of them that signed up for your program, Ken. And it's like, well, you have 900 grand next year. Based on your forecast, you will have 900 grand in cash. What the hell are you going to do with it?
Leaving it in the bank account, which is what a lot of companies do, is not.
You're losing money then. Yeah.
They're losing money. You're losing value.
Because of that, and that's where I'm talking about the 8% money supply growth, and then you got inflation or the cost or the opportunity cost of putting in the S&P 500, right?
Well, plus it's an annual view. It's like, okay, 900,000, how does that drive long term? Right? It's like, really, what are you going to invest in, and where are we going, and how we get to your point of setting goals and objectives and longer term stuff. You know, that's the power of that decision making.
Well, and so this is where, and John, thank you so much for letting me go through my little therapy session here. Is I think there's so much stress that owner operators place on themselves of thinking that they need to have all the answers, or they default to back of the napkin gut decisions of like expand to buy a competitor or launch a new product or service. But there's a lot of this back of the napkin gut instinct versus I Ken, on our last conversation, it was like the 8 functional areas are the theory of constraints for cash flow and like how to grow it. And I just love that thought process. So maybe where do we want to start on the 8 functional areas? Maybe John, let's start with you of like, why did you realize that what Ken was doing was different, or like what you were working on, and how did it fit into what you guys are doing now?
Yeah, well, one comment before we go there, right? You were making the comment that so many business owners are challenged with this part of their business, or they make these back of the napkin kind of decisions. I think one of the things that we just have to really recognize is that owners have been successful at smaller businesses, and they continue to grow them slightly and a little bit more. And some of it's luck, and some of it's really good hard work, but it's usually not strategic.
Right. And can I add to that, which is fascinating? Because I think, Ken, you met my buddy Brandon Henry. And he was on the podcast recently again, and he's talking about his clients that'll have $200 million net incomes. And here's why I think that why it's possible to get that big and not do what you guys are talking about is it's literally a good cash conversion cycle. Like they get lots of money up front from projects or something like that, and they're able to just flop forward because of the cash that they have. And there's enough market demand, and they're working hard. Yeah, do you feel like that's
doing something right?
Fairly,
yeah. Well, those are also,
but it's not because it's that precise, like what you guys are talking about.
That's also the exception, Ryan. You don't see too many of them.
Mm-hmm. Well, which is why there's only so many companies above a certain price or certain size, right?
Another time, Ryan, we'll get into like how different investment allocations of capital in a company can earn different returns based on how they're funded. So one project might be funded with all equity, another investment project might be funded with some debt, some equity, another one might be funded with all debt. Those would have three different required returns. Collectively, the company still needs to earn a collective return in excess of its hurdle rates.
Because at the end of the day, your company is like a portfolio
Yes,
that BlackRock would be managing, right? You're saying,
that's right.
okay, because like one of my clients is like, okay, well, if you have to buy $1.5 million tool and die cutting machine, you're gonna finance it. You can finance some of it, all of it, and like, what are you gonna do with the cash? And at the end of the day, it's the same thing as your house, right? If you got $1 million in equity in your house, like, is that the best place to keep your money? You should probably go take out, for sure over the last 15 years prior to maybe now, it's like you should have gone taking out debt and put the
Yeah.
money somewhere else, right?
Yeah. And that's like one more point on that concept of taking out debt, because a lot of companies we see, we don't want any debt. We have no debt in the company and we don't want any debt. Well, one big advantage to having some debt in the company is it reduces your hurdle rate. So it allows you to make investments that will increase the value of a company that you wouldn't be able to make if you didn't have any debt in the mix.
Well,
Because your
and
hurdle
just
rate is higher with
and
all
the
that.
right, it isn't the simpleton way of thinking about that is like if your house is worth $1 million and you have no debt on it, and your house is growing at 5% a year, like you're an idiot to keep from an investor perspective. There's for whatever emotional reason you want to have no debt, fine. But like if you're constantly trying to, in the pursuit of growing wealth and getting a return, keeping it in your house is the stupid way to do it. I mean, like case in point, Michael Saylor with MicroStrategies, he's raising fiat debt and buying Bitcoin, and he built a currency recycling machine, and it's just proven that he's constantly chasing the higher return. But like back to the whole, just even your house in cash, have no debt on your company. Like you could be, if, and this kind of goes back and back to the question, John, is like how to determine what to work on. Because I think a lot of people default to, I'm going to take my cash and I'm going to pay off some of my real estate loans, or I'm going to do this, or I'm going to pay off my line of credit. It's like, well, that what I'm hearing is you just have no plan on how to grow the return of your company. So you're making shit up.
Yeah, I think, let's go back to that question you said. How did we, Ken and I come together, and why did I see the value of the 8 fundamentals and all that is, um, if the core principles of what we work on is you have to have a solid company to achieve outcomes, whatever those outcomes are. Instead, people tend to focus on revenue and profit as their objectives, but they're outcomes. Do you know what I mean? So the whole idea was when I was doing it, I was looking at the fundamental areas and doing it on an Excel spreadsheet and saying, how do I score them? What kind of capacity and competency do they have? Ken brought all the financial aptitude to it. That's where he blew it up and really made it something really powerful and connected those pieces. So it's a matter of looking at it and saying, you guys might be generating some good cash right now, but how are you going to grow? Where are you going to grow? And can you sustain this over time? Right. That's what we're really, that's the whole model. It's like, what are your capabilities and competencies? Because the world around us is changing rapidly. The opportunities you've had, your shelf life of product life for services is shortened because of, commoditization and all those types of things. So it's really looking at those fundamentals and saying, okay, you said you're going to grow through acquisitions. You're not even running your core business well. How are you?
Oh, that gives me so much heartburn when I hear people going like, I'm going to grow through an acquisition. I'm like, you have a dog shit CRM, payroll system, and financials, and you're going to bolt something on top of that.
Well, we usually don't say it that way, but we tend to agree with you.
Well, John, I had my own business, man. I can tell you what it's like running a 100-person company with no org chart, right. And it's not fun.
And what we're finding is, some of the tools and the process we use tends to be, there's no intellectual challenge, right? People get it. The real challenge is helping them transform and change from the way they used to do things to the way they should do things. right? So there's a lot of
what is the biggest change that are you talking about their culture or the owner
all the
operators
above.
minds? Okay.
All right. So when you think about what leadership is and the roles that they should play as they continue to think about growth, how they engage
Mm-hmm.
employees, the value of their employees, the input their employees contribute. I mean, if you think about a business that was small, the business owner could handle solving all the problems. But as you grow, you can't do that anymore. So
Mm-hmm.
that
Mm-hmm.
business owner has to float up. They have to become a CEO rather than a manager, right? And how they think about where they invest their money and how they hire. And rather than adding a person being a cost, adding a person is an investment in your future and being able to do something different or better,
Mm-hmm.
right? And it's helping them really.
Well, on that, just to double click on that part, John, is one of the things that I've seen that is an output of the training material that I've developed over the years is by helping them people shift their mindset to a return if they understand the value. I've seen a propensity to change and be excited to do hard things because they know why they're going to do it. It's not a use of cash and going to reduce their net income. It's like, I'm going to do this as an investment and I should like, if I can judge that return, that is something that I find as an interesting byproduct of understanding value and valuations. But then there's the how do I do this and how do I cascade that thought process down through the organization that becomes a bigger challenge, and to get their executive team to understand that and then to go all the way down through the organization. So I mean that's kind of been your jam from what I've gathered as far as like how to cascade that out. How do you see what happens when people do that well? Like, what are they doing the right way? And what are they doing
What
what are they
what
doing
they're
right?
doing the right way is they're acting like leaders instead of managers. They really are out communicating to the various levels in the organization, saying, here's where we're going, here's why we're going there, and here's what it means to you and how we have to help you do your job. Right? And they connect the various layers. Like you go to the front line of a company and you say, we're going to grow tenfold. They're looking at you saying, what does that have to do with me? Right? You got to really
Oh, and like, does that person even know what they mean by
tenfold.
tenfold? Probably
Exactly,
not.
right? And we're gonna go,
Yeah.
our strategy is this, that, and the other thing. The person's like, okay, yeah, but I'm in
Yeah.
customer
Yeah.
service. So how do I? So that's the important part is really, and there's, it's funny. I just happened to pull this book off the shelf. It's called The Last Link. And the book is written about the disconnect or the inability of organizations to take all that wonderful stuff you did in strategic planning and making it come to life for employees.
Okay, so hold that right there, because I am totally tracking you. And so back to how I opened up the conversation, John, is like, I need to understand this so I can forget about it. But then when I
But you
say
can do
forget
it.
about it, but what I think is so fascinating as I've learned all of this stuff over the last 10 years is that when I see the dysfunction in these companies, and I've been inside hundreds, and it's like, and you guys probably see this too. It's, you can see the dysfunction just like that. If people didn't come from finance like you did, Ken, like most people don't know why they're doing what they're doing. Like they literally don't know why. And like the clients that I'm working with, like, or like so John, my dad and I had a family business, did about 20 million. And like, it's like, I want more money and I want more independence. That's why I started doing this. And I have the opposite of that. So it's literally at the end of the day, I want time, cash flow, and wealth. But then by not understanding the topics that we started with, it's so hard to see the through line. So then how am I supposed to communicate to the customer service dispatch team that if you just work harder, I will eventually have more money and have more
Well,
time?
see, but that's part of those are some of the principles, right? I mean, when you interact with a business owner, it's like, okay, what does motivate you? Like one of the things you guys said before, that big company you said, and the lady said, I don't care about making more money. I want to protect my employees. I want to protect my people,
Yeah,
right? So
it's a
each
clear thought.
right, each business owner is in business and has outcomes or goals for themselves personally that you want to uncover. You have to understand them.
Yep,
But if
yep,
you turn
yep.
around and make those personal goals the business goals, that's where dysfunction starts to happen.
I disagree, because if a business owner who is privately held does not clarify their personal goals and they have no idea how much cash flow that they need or what their return is, they're going to go into their annual planning meeting and have no idea how much money they have to reinvest, what the timeline is. And that's the biggest problem between owner operators that are privately held and PE firms and ESOPs, where the ownership goals are clear because they're forced to be clear versus the person that's just focusing on revenue, net income, and the bank
So
account.
you and I are saying the same thing. I explained it the wrong
Okay.
way, right? It's what I'm saying is,
And I respectfully disagree, by the way.
no, fine. I mean, we should.
Jane, you ignorant.
Yeah, that's right. We can stop there. But it is about, you absolutely have to have clarity in your goals. All I'm saying is if you turn around and make the mission of the business to be making money for that owner and that's all they exist.
Oh, totally.
See what I mean?
Yeah.
Right. So now you
yeah. Well, and by the way, like my old partners, they sold their ESOP to a private equity firm. Day 2, everybody knew it went from about the people and about the community to making money for 12 people that was in New York. I mean, like, and it flipped that fast. And there's no one that can argue with, it's just a fact. They went from making returns for the employees to making returns for 12 people in a pension fund. Doesn't mean it's right or wrong. It's just different. Yeah. But the thing is, by ignoring that truth, we're just lying to ourselves.
Well, you get acquired by, all of a sudden there's a roll up and a PE firm is behind it or something like that. All of a sudden, what are the metrics? Revenue, profit, efficiency and all that stuff versus why are we doing this? I mean, one of the challenges we face as business owners and companies that employ people is that more and more people want to, be part of a company that makes a difference and is doing something for a reason. Those are the companies that excel beyond most other companies.
I don't know, John, can you see? I'm doing it backwards. That book, Conscious Capitalism.
Yeah.
Have you familiar with that book? I mean,
Yeah.
It's fantastic. You're preaching the mission right here, which is, I mean, it's capitalism at its finest. Yeah. And the reality is who's making the returns does matter. And then because at the end of the day, I think this is what you're saying, John, is like how those decisions cascade through the organization is a direct reflection of the owner's goals.
The leadership team and the owner's goals. Absolutely. Absolutely.
And so if there are selfish, you could probably look 5 layers down and you could see it, right? I mean,
well, it's funny, it's whether people like it or not, the dysfunction of any company is a direct reflection of its leadership team.
Which I would say would be a direct reflection of the owner's goals of cash flow and equity, because all of that gets pushed down. And whether it's the VC startup or the PE firm or the ESOP or whatever it is, those goals and the timeline, back to Ken, your timeline will drive what dysfunction or lack of dysfunction is rippled throughout the organization.
John threw out a concept a few minutes ago that I just want to sort of double back on for a minute, which is the idea of planning, because everything that you're talking about all starts with planning. And unless companies have a really well-developed, clearly defined and articulated vision and roadmap for the future, then they don't know where they're going or how they're going to get there. They're just chasing business. And I think that's what gets so many companies into trouble, is they're just chasing business. And they don't know where they never step back to think about where they're actually going.
So John, I agree with you, Ken, and I want to then tee you and Jen up to explain the 8 functional areas and how to approach planning. But I'm sorry if I'm being stubborn or thick-headed here. And back to your, the owner, when I say ownership, it's the owner of the asset. I have become such a believer that the ownership team, or not even the team, because I think about team as like the operations. And this is where I'm bifurcating, John, where there's the leadership team of the operations where people are making W-2 income and they're driving the operations to satisfy owners' goals. But the owner's goals is the IRR that we spoke about at the beginning, right? Which is what is the cash flow and the final outcome target, because that's the only way we can see the constraints or the available resources for the operations. And I guess, John, where I've landed with all this for 10 years is like, by not doing that, it creates insane dysfunction in the operations. But if we can actually take the owner and say, you have to do this planning on the ownership side, then you can come in and say, all right, John, from the operation side, we have no idea what a plan. We need to hear you, how you're going to approach planning, but we now know what our constraints are going to be for cash flow and the value target. What should we do now? But to not do the layer that I just described can provide, it just enables so much conflict and dysfunction. I think it's just ridiculous, unless you agree or disagree. But because I think that is like the handoff where if I were to have done that and then I say, all right, John, here's the goals from the ownership asset side. Now, what should we do and when should we do it and how should we do it and what should we expect is a whole set of situations that you guys have figured out how to tackle. What do you think about my thought process?
No, I tend to agree with it. I think it's a sequencing issue, right, as to when they do it. Some aren't
like how you said that,
sophisticated and aren't ready to do that when you first do it. But there's an enlightenment as you go through this that they realize that, wow, we can actually drive outcomes. I can actually make more money. I can start doing these. I mean, most business owners just don't tend to think that way. I mean, some are motivated by money, no question, but others aren't. And it depends on that business owner and how you can educate them. And that's where, Ken plays an important role up front. When a lot of times when they're doing the VOP, it's all about understanding the opportunity from a value standpoint, right? Having a driving force. And then the rest of it is building in his organization that is just well run.
So let's dive into your, the planning,
Sure.
what the VOP means for planning.
Sure.
And I mean, I think it's such a beautiful thing that you guys are doing and how it fits in.
Well, if you think about our flow, our process, right? As Ken said, I mean, the VOP is an assessment of your current state. It just goes in and says, what do you have for capability and competency, and what's your financial position and value based on a VOP model. So now we have a starting.
And that's the 8 functional areas.
Well, that's the 8 functional areas in our question.
Yep.
Going through the VOP and coming out with the report and having the summary. But it's our starting point. That's our current state. The next step is you need a plan. So there you do strategic planning, right? Goes through that whole
future
process.
planning.
Before we get into strategic planning, because here, I think that this is where I have found the practicality, and I've had the people that have engaged with you Ken, I've had to explain to them how these different, this back to use your word, John, sequencing happens is they're like, well, I think I need a strategic plan, then the VOP. I'm like, no, you don't understand. If you're going to spend $40,000 hypothetically in a strategic plan, do you know that you should do that, or maybe a new HRIS system, or maybe a new ERP system? You're not sure. So maybe if we could zoom into just the 8 functional areas, why are there 8? And then how does, because strategic planning is not the VOP, right? And I've had to really explain that, Ken, to quite a few people to say you need to do the VOP first to understand and why are they have to be in balance, and what are the 8 first, and then what comes out of that, and how do you work on them in the right order? Does that make sense?
Yeah, that's fair. So some of the origination of the way we organize the 8 fundamental areas comes from the behavior profile disc. And it really, when you look at it, there's the driving pieces, there's the influencing pieces, there's the system and process pieces, and there's your controls. So we looked at the driving forces of saying we need to understand our marketplace. We need a very big strategic plan. We need direction for our company. We need leadership in our company that can communicate that. And so that's how we formulated the planning and leadership pieces of it. And we looked at it and said,
Okay.
What kind of experience do they have? Do they know how to lead? Have they ever done this before? Right? So we get a profile of that. Then we go into the influencing section, was all about revenue. When you think about influencing from a profile standpoint, it's influencing others to your way of thinking. So it's your marketing and sales engine. It's what clients should be.
So cool. Yeah.
Right? How do we influence them? What's different about us? How do we communicate? How do we position ourselves in the marketplace? Why should they buy from us? It's those pieces. So that's where we go from sales, which, by the way, sales is a combination of getting a result and influencing others. So it sits right on that line. And you get to marketing, and marketing is more about ideas and people and influencing the thought process. So that's your I. And then you go into the S part, which is your system and processes. And how do we attract, retain, reward our people? We need a whole system and a model around that. And then operations is how we do our work. It's all the process, procedures, equipment, systems, IT, all that goes into that area. So we've
So fascinating. That's the first time I knew that like there was disc influence, but like I'm now picturing the 8 functional areas and like the X and Y axis. Fascinating.
And then the top
cool
left is your controls and the compliance part of an organization, which is the checks and balances and the rules. So you have all your finance rules, you have your profitability assessments, you have your budgets, you have your financial models, you have how do you set up the legal entity of an organization? Are you honoring your laws? Do you have contracts in place? So that's how we plugged it into that area. So those are the 8 fundamentals. Now, what sits on top of that is how you manage the company and your culture and those types of things. But that's kind of the way we allocate it.
What I like about that, John, and what I've ever since I got introduced to it from Ken's program when I went to it is it doesn't matter whether you have a lemonade stand or your Apple. Like it's just like an engine of a car. Like there's the fundamentals, but then there's the things that make the car unique. And this is where and it sounds like you got some of your experience on is the culture is I've always said, John, like the culture is the DNA of like if the ownership goals have been clarified, and then there's the 8 functional areas that becomes the direction, and like you said, like people are the things that make it all work, and everything ends up on the income statement and the cash flow and the balance sheet, right? Like so, like but the people organized, communicating effectively. This is a communication tool and a direction tool that allow everybody to function at a higher level.
Absolutely. I mean, if you think about historical, right? The Industrial Revolution, machine drove value. They drove efficiency, they drove productivity, and all that stuff. Now that we've moved to the intellectual age, it's people. And the systems and processes are automated, and those types of things are off. So now it's really about people interacting with people and behaving in certain ways that are your differentiators. You can create the best write-up when it comes to a brand that anyone can think of. But unless your people understand how to actually behave and live that brand, it doesn't matter.
I love it, John. And I will have to send you. I interviewed Bill Mills. He created this cultural. He called it the leadership process. And I think there's a little bit of. I mean, leadership is such a fluffy word, right? However, he did it. But he did it from an engineering perspective. And Ken, you would have gotten a kick out of it because he took it from a theory of constraints with people, and that he identified that 2.5 hours of everybody's day is full of drama and lack of communication. Where if you are constantly, yeah, right. Yeah. And I'm like, well, that might be in the best.
We're human beings,
yeah. But like to your point, John, which I think is fascinating, where like he's got this process of how to integrate and it constantly be reducing that friction and increasing the effectiveness of the communication. Right. But I see the VOP, John and Ken, as a way of communicating what to be working on, how it all ties to the goals. So people, like back to your a while ago, John, people know how they fit in.
Yeah.
That frontline person, that last link knows like, what am I doing and why does this matter? How does this tie into the whole thing? And so explain
the strategic planning. When you take the top level and you start with very overarching objectives, and then you chunk those down into smaller and smaller bites and push them down deeper and deeper into the organization, that's where you get all that connection to every employee. So everybody sees and understands where they fit, how they're adding value.
Well, and so 2 things. One is as you start to really understand behavior preferences and ownership and start to assess them, forget about VOP for a moment, you can pretty much walk into businesses and understand the owner's preferences. The ownership is, their preferences, their business is a direct reflection of their preferences.
Yeah, right? I agree with you, John.
Until they're more advanced and they really understand and they have more awareness. But if you walk into an engineering firm, it feels and looks like an engineering firm because it's run by engineers, right? Same thing in a marketing firm. Different types of firms. You'll see the behaviors and the preferences of those people.
Because it's made in every choice of
where they
what
think.
are they like, well, like it's like, are we going to be doing happy hours at 3 or
Exactly.
not? Are we going to be like, how are we handling our customer interactions? How do we handle, positive behavior, positive reinforcements? Are we wearing jeans? Are we wearing khaki?
Yeah.
I mean, like all that kind of stuff is just perpetuated from the person that has the highest power.
And the once you start to help people understand that, the biggest advantage is that they realize that their opposite is their perfect partner. What you need is balance, right? We talk about this all the time, and it's not perfect balance, but it's capability and competency in all the areas that's adequate to do and deliver on where you want to go as a company, right?
Right. And you know what's so interesting, John, and I'll be careful here because I am not a sports guy, unfortunately. And so yes, I played soccer growing up, but I just think about a football team. Like, you can't have everybody be a quarterback. Like, it's just so ridiculously straightforward, and everybody knows that. And like, if you're just gonna hire everybody like yourself, I mean, Ken, when I went through it and I took, I'm like, well, the reason we didn't have an org chart, we had a crappy financial system and all that stuff is because my dad and I just love sales and marketing. And it was just a direct reflection
Of who you are.
of all the enjoyment,
Exactly.
right? Yeah. Versus saying like, hey, what's the team need to look like? And then by the team, it's like the functional areas what does good look like in these different areas objectively,
Well, now
not
take it a
subjectively.
level higher. Take your sports team as an example, right? The players and everybody being quarterbacks, they're a subset. They're like operations because you still need a marketing
Mhm.
firm. You need a finance team. You need where are we going as a company? How do we differentiate? How do we attract players? How do we need all
Now you're talking. Now I can get down on the sports
see what I
situation.
mean? It's a
We're
business.
talking about it in business terms.
I mean, look at
Yep.
look at the colleges and universities today with NIL. They have to change everything they've done around sports
Mhm.
because now it is a business more so
Business.
than
Yep.
it's ever
Yep.
been.
Yep.
Right?
Yep.
And it's just wild how it's progressing. But
So going back to the strategic planning and then chunking it all the way down, strategic like planning is one of the 8 areas you guys assess. So this is where so maybe I'll propose the challenge or question that I've had for years after being exposed to the BOP is that, so like, I know they all need to be in balance and they're all important, but then I go, okay, well, like, we got to have financials because like we can't just make shit up as far as like the numbers. So there's like a level of importance of that, but then also strategic planning. Like, so this is where I start to lose myself of like, okay, like they're all 8 are important, but then like there is kind of an order to this too at the same time. So like, Ken, I
Well,
don't know if you have
so
thoughts on.
within the 8 primary categories, they're all of equal importance at that level, at that highest 8 category level. Then each of those 8 categories has a set of subcategories. And the subcategories have priorities within them. So some subcategories, they're either level 1, 2, or 3. Level 1 are the most foundational subcategories that if a company is weak in level 1 subcategories, then that could be catastrophic. If they're okay, so
And you're covering all level ones of all 8 first and then going out.
ideally you want to be strong in as many of the level 1 subcategories as possible.
Okay. That's what I thought. Yeah. Which makes sense.
And then move to level 2 and then move to level 3. Now, companies, just the way we find them is that they have all different levels of development across those 3 levels. They're not like some companies, they might be strong in some level 3s and weak in some level 1s, and like they have this. It's not because they don't know
Well, back
what's
to John's
going on.
point is it's a reflection of the ownership and leadership
Exactly,
team and
yeah.
the things that they're liking to work on and what they're doing, right?
Right. Yeah. So, like the fact that if a company doesn't have financial statements, that's clearly a level 1 subcategory, like
Got it. Yep.
foundational need or weakness that they have to fill.
no strategic
And the
plan.
reason, John, I was bringing this up because like strategic planning becomes something that I see as like
Level 1
okay, got it. Yep.
pops
Yep.
right out. So you don't have your direction set. You don't have a plan for the future. Level 1.
And can you compare and contrast your definition of strategic planning compared to EOS traction? Because a lot of listeners in here will be thinking about that. I've done a couple episodes on this that I'll put links to in the show notes, but I think it's important to level set it again.
I'll take a crack at this first, and then John can chime in. But because I've probably answered this question, I don't know, at least 100 times over the last couple of years, and I have an article written about it that's in our community portal and so forth as well. But
if you want to send that to me, I'll put it in the show notes too if you want.
Okay, we'll do that. So EOS is it's an operating system, right? So it's all about tracking and accountability and monitoring progress and all of that.
Which it does well.
Which it does well. Yeah, no question. The issue is in the upfront, the front end of it.
The inputs.
The inputs, specifically determination of the rocks. Because, and I'll use an example that I often use, a company that John and I have worked with over the years. I got introduced to them years ago. I went to meet with the owner. He said, we're running on EOS. We've had an implementer for several years. We like it. We like the discipline and focus, but just doesn't seem to be moving the needle. And he asked me, like, why do you think that might be? And so I said, okay, I just met him. So I was asking him questions about the company and his team and everything. So I said, all right, after talking to him for a while, I said, okay, well, how do you develop your rocks? He said, well, once a quarter, we all get together off site. We spend half a day and we talk about what our rocks are, what our rocks should be. And those become our rocks. And that feeds into the rest of the EOS system. And I said, okay, well, let me get this straight. You guys, your leadership team, you have 5 of you on the team. 4 of you are plastics engineers. And the 5th one is your CFO. And so plastics engineers and the passion of all 4 of you is product development. So where do you guys really think, you really think that you're developing your rocks with an objective understanding of where the weaknesses and constraints are in your company? Or are you developing your rocks based on your passions? And it was like a V8 moment for him. He literally just was like, oh my God.
That was a long time since I thought of that commercial. That's awesome.
He was like, oh my God, yeah, you're right. I don't know where our weaknesses are. And I said, well, that's the difference between that's how we fit into the EOS process. We are the front end to shine a light on all your weaknesses and constraints, so those can become your rocks. You strengthen all of those areas, and then the company can move forward. Without doing that, you're not going anywhere.
Okay, unbelievably clear. And I love it. And that is exactly how I've been communicating that to all of my clients and to my audience. But I think that's important to differentiate from strategic planning, which I think, John, you'll get it. That's what you wanted to maybe chat on or contribute to, because but planning is one of the 8 areas. So just to kind of go back. Right. Yeah. And just to level set again, just so we have, for the audience is clear of like the different components or the different systems we're talking about, where they fit. Like where I feel like I have found a spot in the marketplace, Ken and John, is the independence by design is the owner's framework for them to help understand their goals and their mission and like what they want and how the business fits into it. And then how to tie all of these things together. So if they do that, then they need to, so they have to do a lot of work on the big picture, call it private equity family office kind of intersection. And then they can come to the point like, how much money do I have now each year going forward to reinvest? And what should I do with it? Insert VOP. Then the execution of that is more like the EOS, but they're still needing to spit out one of those, like the rocks. One of them, level 1, would be strategic planning. So if they went through, so that would be. I see, John, I want to hear your thoughts, because you're kind of slightly nodding. Here's what, but sorry to interrupt, because my clients, they're just like, a lot of my clients are going through this process and like they sign up for the VOP because they're like, I don't know how we're picking our rocks. I'm like, you got to sign up for the VOP so you can figure out what your rocks are. And then as an output of that, a couple of them are going to have to do formal strategic planning. But they were trying to, I had to like I helped them put the brakes on because they were going to go do strategic planning first and then use strategic planning to pick the rocks. And I'm like, that's a wrong order.
Well, I just want to be a little careful with tying our level ones to rocks and all that fun stuff. You know, I think the important part is the idea that you need to understand where you are today as an organization, period. Your competency and capability and when you assess through the VOP, if you really look at an organization, you can see where its weak points are. Okay, that's done. One of the first things that comes out of it, we have yet to find a client who hasn't done this. I mean, even if they have strategic planning, say, yes, we have one, they're not using or it's not done well, right? So the strategic plan helps them build a picture for the future.
Right. And so, okay, I'm tracking you. And the only reason I'm interjecting again is because I want to take a self-check here to say, is it because you two like strategic planning so much that's what you gravitate towards? Because guess where Pat Hobby used to gravitate towards? Finance. We would do the VOP, and every time finance was weak. And I've seen that now for 7 years that like you could easily go and pick the low hanging fruit of finance being the same one. So this is why I asked, like, with the 8 functional areas and them being all necessary and balanced, is there an actual order? Or is it like just assessing where they're at and then tackling that one first?
Every company's different, and the order will come out of VOP and strategic planning together, right? So the VOP will give you the roadmap to balance your organization, but only in its current state.
Right.
It doesn't address what you need to be in the future.
But I'm tracking you, John. But here's the reason I'm pushing back is because every time I did the VOP or worked with a client, when I had a fractional CFO business, every time the CFO services and the finances were the thing that, like, because I could argue and sit here and go, like, your financials are literally terrible. You have no idea where you're even making your money or whether you can even afford a strategic plan, and you're going to jump right into strategic planning.
Well, I would say, I think if we worked with a company that had disastrous or no financial reporting, we would probably take that on even before strategic planning.
Would you listen to the VOP's results, I guess, is the question, right?
We would listen to the VOP results, but we typically work with larger, companies that are a little bit larger that have financial reporting that's decent. What's that?
Like what size? I'm just curious for context.
I mean, I think 5 million is like the bare minimum, but we typically work
with
companies that revenue. We're typically working with, 10 million and up.
There's a strong correlation to the size of clients that I'm working with. Because I mean, if I'm talking that my clients are usually $1 million to 4 or 5 million in EBITDA, there's the same. But and I have yet to have anyone have a 3-statement tied together model where they can see their working capital, their distributions, their taxes, and the future forecast. So then they're just literally making stuff up. And they don't even know what kind of cash flow they're going to have in the middle of next year.
So here's what I would say, right? I get your thought process, and I'm tracking where you're going in terms of the finance and the importance of it, right? Because you're driven by the fact that you're in business, you got to generate revenue and all those types of things. What we're trying to help owners build is an organization that will deliver revenues and a stream of income time after time without them. Right. It's
which I want to, and just 100%, John. And I just want to be clear that I'm pushing back just on the financials, because my original question was, are you guys gravitating towards the strategic planning because that's what you guys enjoy versus then being because, and maybe John, because the disc was the first time I heard, the disc. Is it that, what was the input or is that, so is there actually an order to this stuff if everything was kind of roughly the same kind of shittiness? like would we always go towards the D first then?
Not necessarily. Like Ken said, if we walk in and they're just a disaster in terms of they can't produce a decent quality product, or they don't have cash flow. I mean, I think of a client where I ended up, working with them for a long time. And the first thing when, the guy, The owner said to me, he said, I want to work with you. I really like what you're doing. Talk to my the guy who hands all my money and figure out how we can pay you. Right? So you walk in the door and they're in debt. They don't know whether they can make payroll the next week and all that. So you can't do strategic planning at that point. It's really just saying, okay, how do we fix this little problem we have here, and build it? So I would push back and say, absolutely not. We are not doing strategic planning because that's what we love to do. While we do enjoy it, it's just the next step in our process, because we say, if you know current state, you have to create the future state in order to build your roadmap. Now, VOP will build a roadmap for basic competencies, but it means you're stagnant and existing where you are today. What we're trying to do is help the organization think about what they're going to do in the future and do differently from a strategy standpoint. Like, how, we say to them all the time, look, you're a common business. 99% of businesses out there are common businesses. The question is, how do you play the game differently?
And communicate that, and then, because that cascades through, and I agree. And this is where I'm tracking you, and I want to make sure that you don't view my pushback as a disagreement, because I actually tend to agree with you. And this is where, Ken, for years, there's the 8 areas being in balance, and then where to work on them, versus there's a sequential order, because I'm back to my first my brain works at first principles, where it's ownership goals, then the VOP assessment to see where they're at. Then it's depending on their level of, to your point, John, or where everything's at, the strategic plan, where they know where their new identity of where they need to be and what they're going to be as a company, then needs to be rolled into the budget, that then needs to be rolled into the sales and marketing to communicate
marketing, people, ops, finance, legal.
Yeah.
All the way around.
So it's okay. So there is kind of an order to
absolutely.
it.
Yeah.
And by the way, if they didn't have financials, we wouldn't even be able to get through the VOP until those were in place, because the VOP incorporates the financials. Okay. Now, it doesn't mean they'd have to have projections, but they would at least have to have financials.
Well, I think that's where most people struggle, is the projections. They're looking at income statement projection for next year.
We do not accept projections without a company having gone through a strategic planning process, because projections without the underpinnings of a strategic plan, what are they built? What projections based on what? What are they?
Fair enough. No, I love it. Yeah. No, I like it.
Say 3% or 6%.
You need to build the plan first, and then have the projections support the plan.
Yep.
Not the other way around.
Yep.
Yeah. I think the other
I'm looking at the time. Well, I'm good for time, but John, I know you're going to be. Yeah. I don't know.
I think the other thing,
what your deals can too.
It's so critical for us, and why we push strategic planning so much, is it drives clarity at the leadership level of where they want to take the organization, which they can then share with the rest of the organization. Because without it, it's we've heard this many times, right? You tell salespeople to go sell, they'll sell anything. Right? Instead of saying, no, here's how we do it. Here's how we differentiate ourselves. Here are the types of clients that really fit well with what we do. And the more clarity you can give people and ask them to help you go figure out the best way to do it, it changes your culture. It changes your organization. It really involves,
especially the last link to your point, right, John? I mean,
it really involves the collective genius of an organization, and says, you guys, we can't, if we really want to scale, you can't keep coming to us for the answers.
Yeah, and back to your point of this is where we're unified on a mission of getting this systematized to get the owner-operator out of the operator role. And because I know you got to run in a couple minutes. Ken, I don't know if you got time to wrap up. Otherwise, I can respect. Okay, so John, explain, if you can, in the last couple minutes, actual strategic planning. Again, you covered EOS's operating system, but decision trees, I like that in you guys' program. It was the ANSYS matrix, BCG matrix, but what are some things and components that someone could realize, oh, I'm not doing what John just said, so therefore I don't have an actual strategic plan?
Yeah, so I think one of the things that we typically encounter is that the definitions and approach to mission, vision, and values, right up front. And we think those are fundamentally core. We have the highest level overarching company components for the strategic plan, which are mission, vision, values, objectives, and strategies, right? So based on our definitions and the way we do it, right? So the mission is, why do you exist? And it's your core purpose, and throw all that stuff in it, but the difference you want to make in the world. And a lot of organizations have vision and mission and purpose and, the BHAGs, and it gets really confusing. So we simplify that, and we really make sure that those are really clear. And then the objectives have to be, they're smart. They're goals, but they're long-term, bigger goals. And from, with those pieces in place, we can now start chunking that down, as Ken said earlier, and involving the various functional areas and saying, okay, so how do you guys connect to this? And how do you contribute to driving, growth from, we're a $5 million company, we want to be 10 million in 3 years. What's your job in that? How are you going to support that? Right? Marketing, how are you connected? Finance, how are you connected? So we really break down those pieces and make sure that everyone is connected and they understand there's interdependency and dependency in the functional areas to achieve the goals, right? So to us, it's a pretty simple system, but it's the discipline of going through it and really helping people think about it. And we think our strategies are transformational because we force them to think about how they want to, be perceived in the marketplace. Like, what do customers see in you? And you said the Ansoff matrix. So you look at it, whether you're operational excellence or customer intimacy, and figure out that. And the reason why that's so critical is you have to build the organization to support that. Everybody wants to be all things. You can't, and do it well, right? So we go through those strategies and really help them figure out and say, okay, how are you going to grow? Are you going to start adding a whole bunch of new services? Are you going to go geographically? Let's think about that. And they normally don't, right? But once you have clarity and everybody agrees to it, now you start telling the organization, by the way, guys, here's how we're going to go forward, right? But that's a whole communication plan. That's usually where you have to shift.
And is the what I've found is some of the biggest differences from what I have seen from some of your guys' materials, that you have a decision-making set of tools that is making you to make trade-offs, to force you to make a decision.
Well
is that a fair way?
Well said.
Yeah.
Absolutely. Yeah.
The whole framework that we use is a giant decision-making filter
Right.
system.
Got
So
it.
as companies have opportunities that they either find or come to them, they can easily pass that opportunity through this multi-layered filter
Right.
system, and out the bottom they get their answer as to whether or not this is something they want to pursue.
Decision-making framework based on constraints. I mean, that's been the consistent theme, Ken, as you and I have continued to have these conversations. John, I know you're 2 minutes late for what you got to be doing. This has been so fun. I am so grateful for the time you spent with me.
Well, I appreciate all your questions and your challenges, Ryan. It makes us think about this stuff a lot more, and
it's fun, my friend.
Very cool. Well, it's just, as a company, I think that, Ken and I, and Margaret for that matter, are so just engaged in the opportunity to really change how people run their businesses and see the benefit of that, right? I mean, there's a whole different way to do it that no one's been taught. You can read a lot of books and you see some concepts, but it hasn't been done in such a way that they can actually transform their business and do it differently.
Get the return that they deserve. I mean, from the hard work that they're putting in.
Plus, enjoy their business.
Well, John, I'll appreciate you coming in, and Ken and I. You want to wrap up, Ken? I don't know if you got to.
Cheers, guys.
John, thank you so much, my friend.
Thanks,
Bye,
John.
Ken.
What I find fascinating is because I have noticed the gravitation towards strategic planning since I met you, and this is where, like, for the listeners listening in here, because like the way I think about it, Ken, and like I want you to like course correct me, clarify for the audience, because I'm trying to communicate to my clients and to the audience, because I am an insane believer in the VOP, like, to choose the rocks. But what happens is, what I've seen is, then there's this blurry area where all of a sudden we're talking about strategic planning, which is an output of the VOP, just like the finances, just like HR. And so, like, when I think about it, like, if there was one or two things that I think people can't live without, is what the hell is your value right now, and what do you need the value to be to make it worth it, and the cash flow versus equity trade-offs, then how are you going to make your decisions? Like the VOP is like, there's nothing else out there that connects the actual 8 functions and the constraints to the financials, to reality of like internal rate of return, right? Because like the value builder system, all that stuff, they're just making stuff up. So, but like you've tied this all together in such a beautiful way that I'm just and please jump in with like I just want to make sure that what John was just saying about the strategic planning, that's your preference on strategic planning, but that is an output of what I just said of like, there's the financial understanding of your business and the 8 functional areas. Is that a fair way of putting it? I just want to make sure I don't confuse anybody in a way that
Yeah.
you don't.
So the way that I always explain the difference between VOP and strategic planning, and John mentioned this also, I just want to like pile on and drive it home. VOP is current state, right? So it's all of your strengths, weaknesses, constraints, baseline value today. And where are the weaknesses of the company in order to make this a fundamentally strong company at its current stage, or fundamentally strong company that can continue to grow. Strategic planning is the future state. It's the vision for where, so you talk about your clients want to know what value do they need in the future. Well, great. They figure out what value they need in the future. How are they going to get there? That's the strategic plan, is the vision for the future. But it's more than a vision. It's the whole framework, the whole decision-making filter system to help them make the right day-to-day decisions to go from current state to future state in a set number of years. And they decide the number of years. And when they decide the number of years, that drives the outlook of the future state. I'm trying to squeeze my hands in here like that.
I love it. No, my daughter told me to not talk with my hands, so my head started shaking. So,
Well,
I'm tracking you, Ken.
Those are the two, I'll call those the two cornerstones of getting a business owner to get where they want to go and where they want to be in the future.
Okay, I'm just being so dense here, Ken, because like I'm tracking you. I think I'm tracking you, but like the way that I could see. Well, let me just describe to you how I've been describing it to people for years. Is there's the current state, like you just said, the 8 functional areas. Where are you at in all of the different components? And then the future state would be the future state of the 8 functional areas that they would want to be. And then they have to take those, like, if you're going to go from the whatever ratings you have in these 8 functional areas, and then where you want those 8 functional areas to be.
The future state is more than just the 8 functional areas. They need strong 8 functional areas to get to the future state, but the future state is a bigger picture of the company. It's the future state is what do we want this company to be when it grows up?
I'm tracking you, but wouldn't that be the planning of the 8 functional areas though? So like in the because that would be like the way that I think about it is,
okay, if you take the planning part, then yeah.
Well, that's what I'm saying though. Like, cause like if what we're doing is saying, cause like with my clients right now, like they have they did their current state and they want to like enhance the 8 functional areas to get to a future state by the end of 2025 and then to 2030. So there's kind of like the 1 year, then the 5 year. And so they have a target for where they want to take each of those 8 functional areas. So current state, future state, and based on their ratings, they're picking their rocks. So a couple of them might need to do strategic planning because that's what they need. Some of them have a pretty decent strategic plan and they need to work on finance. So they're picking their rocks based on the current state of the 8 functional areas. They're going to be implementing those rocks. One of them might be a strategic plan, but like they're trying to get to the future state of the 8 functional areas, and then the value and the financials will be the judge of that, and the 8 functional areas will be the judge of that. And so then the strategic planning will be something they may or may not need to do. Do you think I'm thinking about this wrong?
I don't think you're thinking about it wrong. Um, I just think when we go through and we think about the future,
I track what you're saying, and but this is where, and I think we're actually getting to the core here, because every time Pat thought the financials needed to be perfect, you guys are strategic planners, which means you think they need to be perfect. If someone is a sales and marketing organization that got the certification, they're going to think that that function needs to be perfect. And I'm sitting here going, I don't give a shit. It's objectively looking at the whole machine and saying we need the whole machine to be rated higher in every functional area. And the return and the IRR needs to be above their cost of capital to make the entire journey of point A to point B worth it for the owner. And yes, that's where, like, I agree with you. I've struggled with, because the strategic plan points that in the right direction. The financials tied, but this is where, like, from complexity theory, you're tying all 8 of them together, saying that, like, they all have to be interlinked perfectly.
they all have to be balanced. They all have to be strong. Um, but remember that we're that the VOP is measuring the fundamentals of those functional areas.
Right. So then if the
Right.
strategic planning function, the fundamentals
It's
of that are
fundamentals. Think about fundamentals and then different levels of, right? It's like an amateur versus a pro athlete, right? The fundamentals, the amateurs are learning the fundamentals. So in the VOP, we're identifying where are the fundamental weaknesses. That doesn't make a professional athlete out of the company. The strategic planning, and I'm just sort of making up this analogy. And,
it's okay. We're thinking out loud. It's all good.
but the strategic planning part of it is looking at the future, and it's saying, well, we want to be a professional athlete when we grow up. We don't want to be a minor leaguer. We want to be a professional big leaguer.
Yep.
And so,
But you're rating
what does
that in the
look like?
functional, right?
And
But
then what do we have to do in all of those categories to get to that level?
I agree. And because the VOP judges their strategic planning, like, if I look at my clients, some of them have they're not on level 1 Mayday. Like, they're doing just fine, but their financials are worse. So, like, I guess from purely objectively looking at all my clients, some of them are just fine with where they're at and where they want to, like, from the planning function. So therefore, like, when they do the VOP, they're picking their rocks, and it definitely is not going to start with strategic planning because they already have a decent amount of understanding of that.
Well, what we find is a lot of companies think they do. I'll give you one example.
I'm laughing because every time Pat wanted the financials to be perfect. And that's why I'm asking, because you guys love strategic planning. Is that where you gravitate towards? Because, like, if you look at, like, where the relativity is, when, like, you can see clearly the gap of where they are and where they need to be. And if we're all bringing our perspective and lens to that, like, that's what I think is the power of the VOP, is the objectivity of it.
It is. Yeah, for sure.
I'm tracking it. I'm not. I love your strategic planning process. I'm just saying, like, when it bleeds from the purpose of the VOP into your strategic planning, that we're kind of, like, I see it. I guess what I've been.
Yeah, I get it. I totally understand what you're saying, and I'm having a hard time, like, disagreeing with that perspective, but it's just not the perspective. And so you're challenging me, asking me if that's our bias. I mean, strategic planning was not my, like, financials. I come from a financial background, right? So
yeah, that's fair enough. It's
strategic planning was not my initial
maybe it's that you love it,
bias.
and we should maybe just, because this is like this is the heart of it, Ken. Like, when I say the heart of it, is like, my passion is just connecting these dots in a way where the puzzle snaps together. Where, like, the fact that I've been gray on this, because, like, where I struggle for others is, like, when all of a sudden we bleed into mission, vision, values, everyone's gonna say, well, I have that, or I have a different version. Like, but like no one I have met has an objective rating system on 8 functional areas that ties to company specific risk, that
Yeah.
ties to internal rate of return, that ties to the
Yeah.
financials, that ties
Yeah.
to the trade-off of cash flow versus equity growth. And like you have crushed it on that.
Yeah.
And then
Yeah.
when it bleeds into, well, we have to do the strategic plan, I'm like, but like half my clients are fine on that, and the other half of them need to do other things first. And like if 2/3 of my clients are using EOS and they have
Yeah.
no idea how they're picking the rocks, go through the VOP every time to pick the rocks.
Yeah.
And then it's objectively analyzing the machine.
I would say then here's what I would say, and maybe this is where we leave it for now until another conversation. But I would say if those clients think they have a decent level of strategic planning, development, and competency, and they're actually using it to track and monitor their product, they're using the EOS system to do that, and they're making the progress in their company that they want or need, then maybe that approach is fine, right? But if they're doing all of that stuff and they're still not getting the progress that they need, then I would suggest that they step back and think about the strategic planning process and whether they really have that in place. Because usually when we ask clients if they have the level of if they have a level of strategic planning development and they say yes, and we ask to see it, like there's one client right now that they have one, they think it's pretty good, and I said, well, just send it to me, let us see it. We're not trying to recreate the wheel. If you guys have 70 or 80% of it and it's in good shape, then fine. We could just help you maybe fill in a couple of the gaps that I can pretty much guarantee you have that might make it more effective. If you don't have it in place, or it's really just not really well developed, then we can take a deeper dive and sort of help you really build a more of a robust plan. So it's not like we have every client where we say, no, you have to.
No, I understand that. I wasn't, honestly, I'm just trying, like, I just find this particular, cause like my brain doesn't stop thinking about this stuff until it like clears itself up, which is why we started about free cash flow and IR. But like, what's fascinating is we could take your exact statement and replace that with financials or sales and marketing. And then that's what I'm saying. Like it bleeds from then the purity of the VOP into one. We're going from like the top level to then double clicking on strategic planning. When you say that, we're like, I have never seen in hundreds of companies' financials, Ken, anybody that has built a 3-statement model like people used to do with Pat. Like never. So like every single time I could say, send me your 3-statement model with all of the mathematically tied together where you could see your working capital, your and like 0 times. And then like I could go through and say how many people I've met that know their client acquisition cost based on their customer journey that ties their sales and marketing into play, and say, of your margin, how much of your margin are you willing to use to buy your customers? I mean, so my point is what I have found as the biggest issue in the marketplace is just pure relativity, where like when I had the old company, my dad and I had no idea what good looked like. So I had no judgment of like, back to if you're in solitary confinement, I don't know whether I'm tall or short because I can't compare myself to someone.
Yeah.
And that's what the VOP does is says, look this is actually what good looks like in these 8 functional areas. Now it's time to judge yourself in all 8 of these against what good looks like. This has been so fun, Ken. Like I find it so fun to just, the iron sharpens iron, and I'm not calling myself iron. Well, technically I am in that statement, but like it's enhancing the thinking for these owners who there's so much exhaustion and anxiety that comes with not knowing what to do next.
Right. Yeah.
And that's, you've played a really good, important part in the marketplace for it.
I'm glad. It's nice to at least feel like you can make a difference in some people's lives and their businesses. So That's what we're all about.
I know my clients have been very much enjoyed the VOP, and that I've been walking through some of the results and stuff like that. It's pretty fun listening to them kind of reflect on where they are at in each of the areas.
We should review a couple of those together sometime offline.
You know what we could do? We could I bet you some of them would be open doing that in the group format if we wanted to just do that in the group format.
Yeah, that would be fine. Fine by me if they're up for it. Yeah.
This has been so fun. Thank you and John for your guys' time. We'll put links to the resources that you guys talked about in the show notes to the corporate value net, right?
Corporatevalue.net.
Yep. And you've got a little bit of a demo on the VOP in there, which I highly suggest people go and check out. That is very helpful. Put links to the past podcasts. Anything else you want to point people towards?
I don't think so. We've been getting more business owners coming to our CVGA program, which is really cool. We've had
shout out to Reed.
we had four business owners come in November, so that's pretty cool.
That's awesome. It's in back to what you get out of that is understanding what good looks like in all these 8 areas, which is super helpful.
Yeah.
So, thanks for coming on, my friend. This has been fun. We'll have to kick it back up sometime after the new year.
Our pleasure as always. Happy holidays, Merry Christmas, Happy New Year.
Likewise.
And stay well. Thanks, Ryan.
If you're still listening, I give you huge props. I am having a lot of fun, and I'm hoping that my desire to learn is benefiting you, because I just want to understand this stuff as much as humanly possible, because I believe that understanding this stuff, whenever I mean stuff, these concepts, it allows me to better understand how to spend my time, because there's all these different advisors, all these different topics that could be distracting, when realistically free cash flow and the valuation of your company when you want it is going to be the most important part. And then how do you place your bets of reinvestment versus distributions? And if you're going to reinvest, you're essentially just placing bets on time to get the return in the future. And by understanding this landscape and what metrics and jargon to focus on or not focus on is super important. Don't forget to go back and check out Tracy Beck's podcast with the 14 ownership KPIs and the financials, where we just break down like all of these numbers of the free cash flow. All of this is visible into the financials, and that is crazy empowering if you build out your infrastructure of the financials like that. And then we can have a better understanding of how to use the VOP to place these bets. And as you can tell, John and I and Ken had some really fun conversations around what's the best use of your time and the investment once you have that assessment of what your risks are at. But what I think is really fascinating coming up in the next few episodes is next week I talked to Jeff Butner from Butcher Joseph, talking about all the different types of buyers, ESOPs, private equity firms, family offices, management buyouts, third parties, and how each one of those ownership structures has their own goals of internal rates of return and timeline, which will impact what they're doing with the business and how they're making their bets. And I think it's really important for you to understand how all of those different ownership games are played so you can match up your eventual goals with someone else's goals, because regardless of whether we believe it or not, capitalism is based on future cash flow. And that's how money works, and that's how businesses work, and that's why they're here. Not to say that conscious capitalism businesses aren't important, but like cash flow is the oxygen of all of business, and literally cash flow is just a stored money of our time that we spent creating value. And so understanding the different ownership structures and how they are playing the game of capitalism is important to match it up with what you want for your business and for your personal goals. Again, the episode after Jeff Butner is Dave Deal, where we talk about deal structures, and because deal structures will significantly impact net proceeds and the mitigation of risk and the ability to hit a future return for the future buyer. And then after that episode, again, I have Ken back on the show because I just can't stop learning about this stuff and understanding how to make it practical. So the last, this episode and the next handful get very technical, but I try to zoom all the way back out and say, like, what matters? Free cash flow and understanding our trade-offs over taking cash out of the business versus reinvesting in the business. If we reinvest in the business, what are our expectations? And then how are we spending our time? So I really hope you enjoy this episode, and I know you're going to enjoy next week's. Thanks everybody for tuning in, and I will see you next week.